Welcome to this online macroeconomics video lesson covering money and banking. What is money? Sounds like a funny question. Most of us think we know what money is. We tend to use it all the time, but can you write a definition of money? So pause the video and attempt to write a definition of money. If you had to explain the convention of money to someone who had no idea about economics, finance, transactions, just the way the world works, could you write a definition of money? Pause the video, write a definition, and then proceed. This quote from Creeping Inflation Business Review, August 1957, from the Federal Reserve Bank of Philadelphia, does an excellent job of explaining money. Money bewitches people. They fret for it. They sweat for it. They devise the most ingenious ways to get it and the most ingenious ways to get rid of it. Money is the only commodity that is good for nothing but to be gotten rid of. It will not feed you, clothe you, shelter you, or amuse you unless you spend it or invest it. It parts value only in parting. People will do almost anything for money, and money will do almost anything for people. Money is a captivating, circulating, masquerading puzzle. Key ideas here. Money is the only commodity that is good for nothing but to be gotten rid of. It imparts value only in parting. This paragraph pretty much sums up what is money. First idea, money is a social invention. For something to be considered money, it must perform these three functions. First, it must be a medium of exchange. Some particulars about medium of exchange. The fact that we have money allows us to avoid the cumbersome system of barter. Back in the olden days, when you went to the market, if you wanted to exchange goods and services, individuals had to have what is called a coincidence of wants. Right? I raise chickens and I have eggs, and you are in the carpentry business, and you said you can repair my fence for 3 dozen eggs. If you don't have something that I need or want, and I don't have something that you need or want, economic exchange cannot happen. So money allows us to escape the cumbersome system of bartering, and therefore it facilitates the convenient exchange of goods. $24 trillion worth of economic production in the United States last year. That's serious exchange. Think about money facilitating all of that exchange and the convenience of having a common agreed upon currency. Last and definitely not least, money allows for geographic and human specialization. Geographic specialization. We do not try to grow potatoes in Florida. Florida is excellent for growing citrus fruits. We do not grow oranges in Idaho. Money facilitates geographic specialization. Scarce resources can be allocated to produce goods and services in geographic regions where it's most efficient. Likewise, money facilitates human specialization. That is to say, a nuclear engineer can concentrate her occupational efforts into running a power plant and doesn't necessarily want to consume all that much of the product, or in this case service, that they generate, but money allows human beings to work in an industry in which they are an expert, be compensated in cash, in money, and then consume the goods and services they need from other merchants. So as an educator, I work to receive income. I don't really need much more economics 101 education, but I can take my paycheck and buy food, shelter, and clothing. Money must serve as a unit of account. What does this mean? We need an economic yardstick. We need a yardstick to say, okay, what is this good or service worth relative to some other good or service? Money serves this function. Facilitates price comparison. You could take a 3-year-old into a toy store and say, look, you can either have these 3 balls or these 4 books. It would be nearly impossible to explain to them that the 3 balls and the 4 books both add up to $10, but they can easily facilitate the comparison between the value of the goods and in this case. Money allows for us to calculate opportunity cost. I can either go to the movies, which cost $15, or I can download a book from Audible, which costs $15. I can either go to a concert, which costs $100, or I can get my car inspected, which costs $100. Money must act as a unit of account, which facilitates price comparison. And in a larger scheme of things, the fact that we have dollars, we can add it all up. Macroeconomic measurement makes sense of total economic production for a nation. Store of value. Typically, people do not spend all their money the moment they receive it or the week they get paid. Money must transfer purchasing power from today until tomorrow, from present until the future. If money fails to act as a store of value, if it doesn't serve this function, it will no longer be money. So if you think about what goods and services cost today and what they're going to cost a year from now, make a list of 5 goods and 5 services that cost roughly $100, and then think to yourself, how much will they cost a year from now? They might not cost exactly $100, but they're going to cost somewhere close to $100 because money, if it functions as a store of value, transfers purchasing power from today until tomorrow, from present until the future. Liquidity is an important economic concept. It is the degree to which an asset can be exchanged for goods and services. Again, before the social convention of money, before human beings invented money to facilitate exchange, barter ruled the world as far as economic activities. But nowadays, people exchange goods and services using money. So by default definition, money is the most liquid of all assets. Think about other assets and ask, how liquid is a certain asset? Gold is a relatively liquid asset because it trades both in New York and London on the troy ounce, and we can easily ascertain its value. If you went to a pawn store, they would easily give you the value of the weight of your gold as determined by the market today. Stocks are relatively liquid because they trade on exchanges, and to the penny you know their value at this moment. Housing is an interesting asset. Sometimes the housing market is booming and sales of homes happen very quickly. You list a house today and it's sold tomorrow. And at that point in time, the market is highly liquid. But there has been times when people list a home and have to wait 6 months or even a year to sell their house. So market conditions will definitely affect the liquidity of assets. In the course of human history, there have been 3 types of money. We started off with a simple approach. The physical commodity was the money. Gold, silver, coins. It could be shark's tooth. It could be, the elephant tusks. It could be pelts from the trappers in North America that came over to this continent. So the physical object is the money. So people believe that the physical object has intrinsic value, and therefore they're willing to accept the physical object in exchange for goods and or services. From that system, we transformed to money backed by physical objects. So we had the gold standard. For a time in the United States, every dollar in circulation was redeemable for a certain amount of gold. We abandoned the gold standard in 1971 with Richard Nixon. No longer does the United States have commodity-backed money. Now the United States and all other nations have fiat currency. So it's maybe disturbing to be made aware of this fact. Hopefully you already knew this, but money issued by government, U.S. government and other governments, has basically no intrinsic value. There's nothing backing the money supply. What gives money value? We'll talk about this in more detail soon, but we need intelligent fiscal policy. That is to say, federal government, when it evaluates the level of taxation and spending, and monetary policy, something that will be investigated in detail soon. Central banks control the money supply. We need a relatively scarce amount of money in comparison to the demand for money to make certain that fiat currency, which is not backed by anything except the government's rule that it is accepted in exchange for goods and services, intelligent monetary and fiscal policy, supply relative to demand, make certain that money holds value. Economists find it useful to have an idea of how much money is in circulation, and therefore we need measurement tools. There are two definitions of the money supply, M1 and M2. What does M1 include? M1 includes all currency, which is coins and cash. So all coin is what's called token money. If you got a quarter from 1964 or prior, keep it because it's made of silver and worth more than 25 cents. But all the coins you have in your pocket, the metal's worth less than the representation. So the money in a dime is worth, it ain't worth a dime. Well, it literally ain't worth a dime in metal. It's worth 10 cents in transaction consumption. And then, of course, all federal notes, all cash in circulation. Federal notes have been issued by one of the 12 regional central banks. Then checkable deposits is part of M1. All money that has been deposited into either a commercial bank checking account or a thrift institution checking account. So currency, 56% of M1. Checkable deposits, 44% of M1. Most large transactions nowadays take place in the form of checks. It's an easier, safer, more convenient way to transfer monies for large transactions. M2 includes all of M1 plus some what is referred to as near monies. So if you observe the diagram down bottom there, you can see M2 includes all currency, all checkable deposits, plus savings deposits and money market deposit accounts. And then CDs, certificate of deposits of less than $100,000, and monies in money market mutual funds. Vanguard is one of the most popular money market funds available to individuals. So M2 includes all of M1 plus what is referred to as some of those near monies. So where do we stand today? This screenshot was taken from April 2023 to give you an idea of money stock measurements in the economy as of right now. So this chart shows you the level of M1 and M2 from November 2021 through March 2023 in billions of dollars. So it has both seasonally adjusted and non-seasonally adjusted. We'll just look at the seasonally adjusted on the left. Notice that M1 and M2 have actually both contracted quite a bit over the past year and a half, 2 years, mostly because of Fed policy attempted to rein in inflation. Since the end of the COVID pandemic, the economy grew like gangbusters, and supply and demand issues have pushed prices upwards. So there you can see there's been a contraction in both M1 and M2 since November 2021 relative to March 2023. Right now there's 20.8 billion worth of M2 and slightly less M1, 18.942 billion in M1 circulating through the US economy. This chart shows us the growth in M2 from 1960 through current time 2023. Take note of the gray area from 2007 through 2009, the Great Recession. In response to the Great Recession, the Federal Reserve, our nation's central bank, took unprecedented steps to help the economy from falling into the abyss because the financial crisis was severe. So in response to the 2007/2008 financial crisis, the mortgage debt crisis, the Fed took unprecedented measures. So a significant increase in M2 between 2008 and really around 2015. The Fed began to take some of that easy money out of the economy. And then, of course, pandemic strikes. And notice again that there was a significant jump jump in the level of M2 again through Fed policy. We will talk about quantitative easing as a new tool used by the Federal Reserve to add liquidity into the system, to put money into the U.S. economy, and the economic rationale behind those actions. You can also see at the end of this graph that M2 has begun to contract more recently, again because the Fed's addressing inflation. It's important to remember that when the Fed manages the nation's money supply, they are aiming to control and influence M2 as our measurement of money in circulation. What about a credit card? Is a credit card money? Seems like it's money because everywhere you go, they accept credit cards, or most places accept credit cards. Well, credit cards are not actually money. Credit cards are a short-term loan agreement between the card owner and the lending institution that issued the card. So no, credit cards are not money. What backs the U.S. money supply? We already identified the idea that all modern industrialized countries operate on what's called a fiat currency. There's no longer some precious metal backing the value of a dollar or a yen or a euro or a British pound. So what gives money value? Now it's interesting to analyze this first statement. All money is debt. What does that mean? Well, Federal Reserve notes, cash in circulation, is debt issued by central bank, and money in checking accounts is debt that banks owe customers. So it's kind of crazy to think about all money is debt. You're like, man, I wish I had more debt. So what gives money value? Generally, we look at these three characteristics. First, acceptability. Dollars are worth something, and typically worth much because they're readily accepted for transaction of goods and services. There's a term called the global greenback that U.S. currency is the most widely accepted money in the history of modern industrialized economies. So the fact that it's readily accepted in exchange for goods and services gives money value. Another factor is this idea of legal tender. It says on dollar bills, good for all debts, public and private. So the fact that the government puts its stamp of approval lends some value to the money. But the most important one is this idea of relative scarcity. Appropriate management, which we will discuss in detail in a moment, but the idea that the amount of money in circulation is relatively scarce compared to the demand for money. If the supply of money grows too quickly, it will fail to meet the three functions: medium of exchange, unit of account, and store of value. Now, money and the prices or price level. So the value of a dollar, in other words, the purchasing power of a dollar, it varies inverse with the price level. So we have this formula D, meaning the value of a dollar equals 1 over the price level. So just simplify. If inflation were 6% this year, you say 1 over 1.06. That tells you how much purchasing power the dollar lost in a year's time. So the greater the level of inflation, the more the reduction of the purchasing power of money. So the value of a dollar varies inversely with the price level. Inflation and acceptability. Germany and Zimbabwe had classic examples of what's called hyperinflation. If inflation gets out of control to the point where money no longer functions as a medium of exchange, a unit of account, or store of value, hyperinflation will erode the confidence of the currency, and it will no longer be accepted and therefore no longer function as money. Modern industrialized economies operate with fiat currency. What backs the money supply? Combination of appropriate fiscal policy, federal government of the United States taxes and spends, make certain that the level of taxation relative to the level of federal spending is appropriate to sustain as close to possible in the long run full employment, domestic output, a healthy rate of economic growth, a relatively low level of unemployment, and an acceptable level of inflation in conjunction with intelligent monetary policy. Control of the money supply, again with this idea of a dual mandate. The Fed is commissioned to grow the economy in an attempt to achieve long-run unemployment rate near 3.5% and keep inflation stable near the neighborhood of 2%. So the combination of appropriate fiscal and monetary policy backs the money supply. Next, macroeconomic concept of concern, the domestic money market. The domestic money market determines the interest rate in the economy, remembering that investment spending and consumer spending on houses and cars extremely sensitive to interest rates. So interest rates are an important component to macroeconomics. Lower interest rates stimulate investment and spending. Lower interest rates stimulate consumer spending on cars and houses. Higher interest rates stifle spending. How do we evaluate the domestic money market? Always make certain you understand what's being measured on each axis. On the horizontal axis is simply the quantity of money demanded and supplied. The vertical axis is where we measure the interest rate. At equilibrium between the demand for money and the supply of money, we have the domestic interest rate. The supply of money is easy to explain. The vertical S curve, supply of money, that's simply M2, the amount of money that the Federal Reserve makes available for circulation. And we will discuss the importance of the Fed altering the money supply to influence interest rates. The demand for money is made up what's called the transaction demand for money and the asset demand for money. We'll investigate these two components of the demand for money in detail very shortly. But remember, most important idea from this concept, interest rates influence economic activity. Lower interest rates stimulate spending. Higher interest rates slow spending. We will examine many interest rates. We talk as if there's one interest rate, but the interest rate in the domestic money market influences important macroeconomic interest rates such as the prime rate, the rate on auto loans, the rate on mortgages, the interest rate on student loans, the interest rate on credit cards. So it's important to remember that changes to interest rates influence economic activity. Let's examine the demand for money in detail, understanding there's two parts to the demand for money. First, the transaction demand for money. The demand for money is partially made up by the transaction demand for money. Every time an economic activity takes place, money must be available to facilitate that transaction. So the transaction demand for money, the amount of money that people want to hold for transactions, will vary directly with nominal GDP. More economic activity, there'll be more demand for money to facilitate that economic exchange of goods and services. So the transaction of money has nothing to do with the interest rates. The asset demand for money, there's an opportunity cost to holding money as an asset. When one holds money as an asset, they forego potential income. In other words, if you took your cash or the money you have in a non-interest bearing checking account and purchased a bond, you're going to receive interest. If you're holding money as cash, you don't receive interest. So the asset demand for money will vary inversely with the interest rate, right? Will vary inversely with the interest rate. There's a significant or severe opportunity cost of holding money as an asset if interest rates are high. If you took your $1,000 in cash and bought a bond when the interest rates are 10%, you could be receiving $80 per year in interest income. When interest rates are really low, as they were from the beginning of the Great Recession, 2008, all the way through really 2021, when interest rates are extremely low, there's not a huge opportunity cost to holding money as an asset. You're not really foregoing much interest when interest rates are less than 1%. Remember, the total demand for money is made up by both parts of the demand, the transaction demand for money and the asset demand for money combine to make up the total demand for money. Let's look at this graphically. First, concentrate on the right. We're going to be ultimately concerned about the total demand for money. So the demand for money is going to be downward sloping like our typical demand curve. remembering that the total demand for money is partially made up of the transaction demand for money and partially made up of the asset demand for money. On the far left, the part of the demand for money made up by the transaction demand for money. Every time economic activity takes place, we need money to facilitate that economic transaction. So if GDP were to increase, this portion of the demand for money, this one part of the demand for money would increase, would shift to the right. When the economy slows down, there'll be less transaction demand for money, and this part of the demand for money will shift to the left. The asset demand for money. Here you can visualize that idea of the inverse relationship between the asset demand for money and interest rates. If interest rates are really low, there's not much opportunity cost to holding money as an asset, so there'll be a significant asset demand for money when interest rates are low. But when interest rates are much higher, one is foregoing a significant amount of money they could receive in the form of interest by buying a bond, loaning the money to a corporation or the government. Take those two together, the transaction demand for money, asset demand for money, and that adds up to the total demand for money. There's an idea called the velocity of money, which will ultimately impact how quickly money is turned over or spent in the economy. The velocity of money, it simply means how many times a dollar is spent on final goods and services. Already familiar with the idea of gross domestic product equals price times quantity, which simply means GDP, the total amount of economic activity, can be calculated by taking the quantity of all goods and services produced in the economy times the price of those goods and services. Now economists introduce what is known as the equation of exchange. And we said, okay, GDP equals the money supply times the number of times a dollar is spent, or velocity. So if we take the total amount of money in circulation, M, and multiply that by the velocity, we could also calculate the total economic output for a nation. Why is this important? Some economists, referred to as monetarists, believe that the best way to control the nation's money supply is simply add into the economy every year the amount of money that you believe will facilitate 3% economic growth, the long run economic growth rate, and the stable rate of growth for the economy. So we take our transaction demand for money, asset demand for money, total demand for money, and we bring in the supply of money, and now we have the equilibrium interest rate. We've constructed the money market. Now that we understand what goes into the demand for money, also have firm grasp of the Federal Reserve, our nation's central bank, controlling the supply of money, we have the money market constructed. Equilibrium in the domestic money market determines interest rates in the economy. Interest rates extremely important for macroeconomic activity. Lower interest rates stimulate spending, higher interest rates slow spending. Assume the interest rate is currently 5%. When and why would the Federal Reserve consider altering the money supply to alter or change interest rates? Assume the economy is experiencing demand pull inflation. GDP extremely strong during an economic expansion. Unemployment really low, 3.3%. Those two macroeconomic variables not a problem, but inflation is an issue. Too much money chasing too few goods. Spending is excessive relative to the economy's ability to keep up with production. Price level getting above the 2% target that's desired by the Fed. So if inflation is 6 or 7%, the Fed would like to slow economic activity. How can the Fed accomplish this goal? Remember, the Fed controls the money supply. If the interest rate is currently 5%, the Fed could push interest rates up to a theoretical 7.5% by reducing the money supply. Reducing the money supply will make fewer projects seem appealing to businesses where the real rate of return now is lower than the interest rate, the expected rate of return on new equipment, machines, projects, lower than the real rate of interest. It will also discourage consumers from buying homes and buying cars at higher interest rates because they have to finance those purchases. Now assume that the Fed is faced with the other economic worry. The economy has slipped into a recession, significant contraction in economic activity, GDP downward, unemployment up, cyclical unemployment, unemployment rate 8.5%. Inflation's not a problem. The Fed wants to stimulate economic activity. The Fed understands that lower interest rates will incentivize businesses to borrow and invest in new projects. Firms will find more projects attractive where the expected rate of return is greater than the real rate of interest when interest rates are lower. Likewise, households will borrow and spend on cars and homes with lower interest rates. The Fed increases the money supply to reduce interest rates. In this case, the interest rate is reduced from 5% to 2.5% by the Fed taking actions to increase the nation's money supply. There is an inverse relationship between bond prices and interest rates. The tools of monetary policy to be examined in detail next lecture, but for now it's important to introduce this idea of inverse relationship between bond prices and interest rates and how the Fed can influence the money supply by buying and selling copious amounts of bonds. As I just stated, there's an inverse relationship between interest rates and bond prices. So if we look at the price of an existing bond, the value of an existing bond, the value of an existing bond will increase when interest rates decrease. And the value of an existing bond will decrease when interest rates increase. This video does an excellent job of explaining how changes in interest rates affect bond prices and how in the real world this can create significant problems for banks who have invested large amounts of their capital into securities, bonds, government bonds with fixed interest rates. A mathematical explanation will firm up our understanding of the inverse relationship between bond prices and interest rates. If we observe up top, 2015, assume that a 10-year treasury, again, what is that financial instrument? The government runs federal budget deficit. The government uses financing to pay for the spending beyond the amount of revenue collected by the federal government. So to finance the federal budget deficit, our nation's federal government borrows money. They borrow using debt instruments known as treasury bonds. So the federal government issues a 10-year treasury at 3%. So if you buy one of these bonds, right, and they're sold in increments of $1,000, you're lending your money to the government for 10 years, and in return for loaning the money to the government, you receive interest. How much interest? In this case, if it's a 3% 10-year treasury, at the end of every year, you'll receive $30 in interest, 3% of 1,000. And at the end of year 10, you'll receive your last interest payment and your principal, the $1,000 back. So that's a simple relationship. If the bond purchaser doesn't intend to sell the bonds, the bond purchaser, the owner of the bond, will never have to worry about changing interest rates because they have no interest in selling the bond before what's called maturity. But bonds are bought and sold in markets all the time in large quantities. Grandmom, grandpop, me and you, individuals, small piece of the market pie for fixed income instruments in the case of government securities. Lots of government securities purchased by insurance companies and banks, investment firms, even foreign governments. So it's a pretty large and liquid market. Let's assume that in 2016, the interest rate on the 10-year treasury fell to 2%. You can see the new relationship here. The purchaser of a 10-year treasury at 2% no longer receives $30 in interest per year. Now they only receive $20 in interest because why? Interest rate 2%, $1,000 loan to the government for 10 years, equal payments of $20 at the end of each year, and principal payment at the end plus the last interest payment. What happens if an investor desires to sell their bonds that they purchased in 2015 if interest rates fell between 2015 and 2016? At the bottom of the slide, you have a present value calculator, and it shows you, okay, I bought a bond with 3% interest, was receiving $30 in interest payments at the end of each year. The interest rate now changed to 2%. That's where it says annual rate 2%. There's still 9 years left. So this is 1 year after I purchased the bond. 9 periods left. How much is the bond going to sell for if I wanted to sell it before maturity? Right, now remember, this would not matter if you planned on holding it to maturity. But if I wanted to sell that bond, well, look what happens. When you calculate for present value, you could sell the bond at a premium, right, above the par value, above the $1,000. You could sell that bond for $1,081.62. Why? Because someone would be willing to give you more than $1,000 for a bond that yields 3% when they can only get 2% on the bond that was issued this year. So the bond issued in 2015 had a yield of 3%. The bond issued in 2016 only 2%. Therefore, interest rates down, in this case bond price up. Bond price went up from $1,000 to $1,081. What happens if the opposite occurs? If between 2015 and 2016 interest rates increase from 3% to 4%? Already explained the 2015 bond mathematics. An individual who purchases a bond in 2015 with an interest rate or yield of 3% will receive 10 equal payments of $30 each at the end of each year and will receive the principal repayment at the end of year 10 as well. Now interest rates increase from 3% to 4%. What happens if the purchaser of the 2015 10-year treasury would like to sell that bond at the end of year 1? Remember, inverse relationship between interest rates and bond prices. Notice that any investor could purchase a 10-year treasury at the beginning of 2016 with a yield of 4%. Therefore, they would receive $40 per year in interest, not $30. That is obviously more attractive. Remember, interest up, bond prices down. So interest rates increased from 3% to 4%. What if the purchaser of that 2015 10-year treasury desired to sell that bond? Let's look at the financial calculator at the bottom. Again, the 10-year treasury with a 3% yield will have payments of $30. The future value is $1,000 to be repaid at the end of 2025. Now the interest rate has changed to 4%. There's 9 periods left. When we calculate present value, notice the number is less than $1,000. This bond is selling at a discount. An individual who wanted to sell that bond would have to be willing to accept only $925.65. Why? Why would anyone purchase a bond for $1,000 with an interest rate of 3% when they could easily buy a bond from the Treasury at 4% for $1,000? So again, last idea, important, inverse relationship between interest rates and bond prices. Shifting our attention and focus to the Federal Reserve System. Historical background. In 1913, an act of Congress established the Federal Reserve, nation's central bank, actually a banking system, largely in response to several bank panics. The primary purpose of the central bank at that time was to provide stability in the banking system. The Fed is managed by what is known as the Board of Governors. There are 7 members of the Board of Governors, most important being the Fed chair. How does one become a Board of Governor member? The president selects an individual to be appointed to the Board of Governors. The individual must be approved by Congress. Terms on the Board of Governors are 14 years. 1 seat comes available every 2 years. This system provides stability for the Board of Governors. It's technically incorrect to state that the United States has a central bank. Instead, we have a central banking system. The Board of Governors is in charge, but underneath the board there are 12 reserve banks, 12 regional reserve banks. We'll see a map of these reserve banks momentarily on the next slide, but collectively the Board of Governors and the reserve banks serve as the central bank or central banking system. There is the FOMC, which includes 5 presidents of the reserve regional banks, assist the Board of Governors with instituting monetary policy. The president of the New York Federal Reserve Bank and 4 other presidents, which rotate throughout the other 11 Federal Reserve banks, serve on the FOMC to assist in administering monetary policy. The 12 regional banks are what are known as quasi-public banks. Every commercial bank and thrift within the geographic designation of a reserve bank is required to buy stock in the Federal Reserve, but they operate as public institutions. They do not operate from the profit motive, but instead to serve the public, especially with the idea of monitoring the health and well-being, supervising banks within their district. The 12 regional banks can be thought of as bankers' banks. Commercial banks and thrifts utilize the service of the 12 regional banks, much like individuals use a commercial bank. Commercial banks and thrifts deposit reserves with the Federal Reserve regional banks and receive interest on those reserves. This role of accepting reserves, deposits, and paying interest has grown in importance since the 2007 financial crisis. The 12 regional banks are spread out across the great USA. It makes sense to have 12 banks serving a geographically and economically diverse country. You notice that there is some rhyme and reason to the distribution of the Federal Reserve banks. New York is the center of finance. San Francisco, with its proximity to Silicon Valley, the center of tech. Dallas, lots of energy economics taking place there. In the Midwest, you have livestock and agriculture. So collectively, our federal banking system serves the purpose of keeping a pulse on the economy and supervising commercial banks and thrifts within their geographic designation. This chart does an excellent job of visualizing the central banking system of the United States, the Federal Reserve System. At the top you have the Fed chair, the vice chair, and the other 5 members of the Board of Governors. Underneath the Board of Governors you have the 12 regional banks. There's a president of each regional bank. 5 of these presidents serve on the FOMC, which provide insight and information to the Board of Governors. The 12 regional banks are also called to supervise the commercial banks and thrifts within their geographic designation, making certain that the banks are operating within the rules and regulations set by Federal Reserve law. Collectively, the banking system serves the public, making certain that the banking system functions as best as possible for the good of households and businesses. The Federal Reserve meets every 6 weeks, so 8 times per year, to set monetary policy. The Board of Governors receives input from the FOMC. The FOMC aids the Board of Governors in determining the best course for monetary policy and in conducting what is referred to as open market operations, the buying and selling of bonds. Commercial banks and thrifts. There are currently approximately 4,200 commercial banks across the nation and 7,000 thrifts which serve individuals and businesses, especially in the capacity of lending to facilitate economic activity. Let's examine the importance of the Federal Reserve banking system on the economy by exploring the various Functions of the Fed. The first function, rather mundane but necessary, issuing currency. If you look on a 1, 2, 5, 10, 20, 50, or $100 bill, there is a letter. The letter denotes which of the 12 regional banks issued the currency, making currency available in circulation, one of the Fed's functions. The second Fed function, extremely important. As stated earlier, the Federal Reserve is the banker's bank. Each of the 12 regional reserve banks takes deposits from commercial banks and thrifts in their geographic designation and pays interest on those deposits. A detailed explanation of interest paid on reserve balances will be covered later. Important to mention this function right now. The Fed can also set what's called a reserve requirement. For the longest time, there was a 10% reserve requirement. What does this mean? ABC Bank has taken in $100 million in deposits from its customers. ABC Bank was required to keep 10%, 100 total deposits, 10 million, 10%, 10% on reserve with the Federal Reserve, setting the reserve requirement. This affected the lending ability of banks. In March 2020, the Fed eliminated the reserve requirement, but the Fed still possesses the legal right to set a reserve requirement for banks. Banks operate out of the profit motive. Commercial banks and thrifts look to make money as a going concern. Sometimes banks make mistakes and are in need of liquidity. Sometimes banks are not exactly solvent. When a bank runs into financial trouble, the commercial bank or thrift can turn to the Fed for a loan. So the Federal Reserve lends money to banks and thrifts. The banks and thrifts which borrow from the Federal Reserve pay interest. That interest rate is called the discount rate. So when the Fed loans money to a bank or a thrift, the interest rate on the loan is called the discount rate. When banks and thrifts borrow money from the Fed, it is referred to as visiting the discount window. This function of the Fed became extremely important in 2007 to assist banks and other financial institutions which were impacted by the 2007 credit crisis and mortgage default crisis. Providing for check collection. People write checks, the checks get cashed, those checks need to make their way back to the original bank. All of this is facilitated by the Federal Reserve. Fiscal agent for U.S. government. What does this mean? Uncle Sam has a bank account with the Fed. Think of the trillions of dollars that the government, the federal government, receives in tax revenues and the trillions of dollars of expenditures made by the federal government on Social Security payments, military expenditures, infrastructure. The federal government needs a bank to execute their deposits and withdrawals. Just like a person needs a bank, just like a business needs a bank, Uncle Sam can't keep the money under the pillow of the president at the White House. Federal government needs a bank. The Federal Reserve serves as the bank for the U.S. government. Supervising banks. Theoretically, each of the 12 regional banks is called upon to make certain the commercial banks and thrifts within their geographic designation are functioning properly, obeying the rules, making certain that they have a level of liquidity which can meet withdrawal demands, making certain that each of these banks and thrifts is solvent. This role of supervisor of banks came under scrutiny both during the 2007/2008 banking/financial crisis and even more recently in 2023 with the failure of banks such as SVB. The most important role of the Fed is controlling the nation's money supply. Already viewed and examined how the Fed can affect interest rates and therefore borrowing and spending by altering the amount of money in circulation. Remember, much macroeconomic activity is interest rate sensitive. By changing or controlling the money supply, the Fed can impact interest rates, which has a huge influence on economic activity. One key component to the Fed's effectiveness is the idea of Federal Reserve independence. As we stated earlier, the Federal Reserve was established in 1913 by an act of Congress as an independent agent. That is to say, they are free from the political process. The Fed chair, the vice chair, the other members of the Board of Governors, they're not elected official, which protects the Fed from political pressures, from lobbying. Why is this vitally important to the economic success of the country? The independence of the Fed allows the central bank to take actions, especially the idea of increasing interest rates in order to curb inflation. Sometimes these actions are not popular. If the Board of Governor members were up for re-election, probably not a decision that would be exactly welcomed by constituents. You would never hear a congressman or woman or a senator stating that they were going to raise taxes or cut spending in an effort to rein in inflation. So the Fed can make politically unpopular decisions to do what's right for the economy because of their independence. Other modern industrialized nations have their own central banks. Here's a list of countries and the names of their central banks. Some of these aren't exactly the most creative names. Japan, the Bank of Japan. Canada, the Bank of Canada. Right? UK, well, Bank of England. Most interesting observation from this list. The EU, the European Union, is an economic unit made up of 27 member countries. What's interesting about the EU and the European Central Bank, the ECB, is that each of these countries had to forfeit their monetary independence when they agreed to join this economic entity known as the EU. And there has been some discussion over the years about the pros and cons of forfeiting independent monetary policy and defaulting to the central bank of the collective EU. The last portion of this instructional video examines the banking system and how banks and thrifts create money. We're going to examine these important economic ideas, and we're going to use the anecdote of the Goldsmith to emphasize how banks create money and how the modern banking system works. The important concepts to be covered are the fractional reserve banking system, the idea of money creation through the loan process, and the importance of bank reserves, and the idea of regulation to prevent a run on a bank or bank panics. The anecdote of the Goldsmith is a useful story to introduce the transformation from commodity money to commodity-backed money and how the fractional reserve banking system makes lending and therefore money creation possible. So imagine an economy in which there are 10 merchants. Each merchant possesses exactly 100,000 gold coins. So the total money supply in this economy is 1 million. That's 1 million gold coins. At this point in economic history, the economic unit functions with commodity money. The gold coins are the currency. But there are two problems with having gold coins represent your money. First, it's cumbersome to travel with gold coins, especially if you have a plentiful amount. And second, not everyone on earth is the most honest and forthcoming individual, so it's dangerous that the gold coins could be robbed. Merchants, think of these as ships or caravans traveling to and fro from place to place, trading goods, wanted to avoid these two problems. How could they somehow eliminate the idea of gold coins being cumbersome and the danger of carrying them along their travels and their economic exchange? Enter the service of the goldsmith. The goldsmith takes the gold coins as deposits and issues paper receipts. Each paper receipt represents one gold coin. So we've transitioned from commodity money to what's called commodity-backed money. So the paper receipts function just as well, if not better, than the gold coins, because it avoids that problem of carrying around heavy, cumbersome gold and the danger of being robbed because the gold coins can be stored. At this point, the goldsmith is practicing what is referred to as full reserve banking. What does this mean? For every gold coin in the depositor's bank vault, the goldsmith, there is exactly one paper receipt. Full reserve banking system. There is no lending possibility if a country practices full reserve banking. One day, an entrepreneurial spirit, a person who observed all of the merchants traveling to and from and quite often visiting their town, realized there was money to be made if the town had a general store. So this person, we'll call them Mary. Mary comes in to see the goldsmith and says, if there was a general store in our town, the merchants would buy supplies from us. The goldsmith agrees, and the goldsmith realizes that Mary is an honest person who can be trusted, and the goldsmith likes the business plan that Mary lays out. The only problem is Mary doesn't have the money to get the store up and running. But Mary proposes to borrow $100,000 from the goldsmith. So let's think what's happened here. There was a one-for-one relationship between gold coins and paper receipts. Now the goldsmith introduces 100,000 gold receipts into the economy, but there is no gold backing up those receipts. So the economy has transformed into what is called a fractional reserve banking system. What does that mean? 1.1 million receipts, only 1 million shekels or pieces of gold. Only 1 million gold coins relative to the 1.1 million paper receipts in circulation. Most important observation of fractional reserve banking. When the goldsmith issued a loan, money is introduced in the economy, the money supply actually increases. And this is exactly how the modern banking system works. When a bank makes a loan, money is introduced in the economy, the money supply increases. Now, let's assume that Mary does very well with her endeavor, and within 5 years she pays back the full amount, 100,000, to the goldsmith. All right. First, we're back to 100% reserve or full reserve banking. And a more important observation, when loans are repaid, money is destroyed. The goldsmith obviously is not going to let Mary have the money for nothing. The goldsmith will charge interest on the loan, and therefore there's incentive for the bank, in this case the goldsmith, to loan money from the profit motive. However, in this system, the goldsmith needed to be what is called a prudent lender. That is to say, the goldsmith could not create too many loans. Otherwise, the merchants would start to question why there are so many receipts floating around, and there might be what is called a bank panic or run on a bank, where everyone shows up at once wanting their money. Perhaps you've seen that scene from It's a Wonderful Life when that exact scenario occurs. Well, in today's modern banking system, there's no more gold. There are checkable deposits, and banks can use reserves to create loans. Matter of fact, there's not even a reserve requirement anymore since March of 2020. More about that later. So what prevents runs on banks or bank panics in today's modern economy? First is the FDIC insurance program. After the 2007 financial crisis, FDI insurance on checkable deposits bank accounts was increased from 100,000 to 250,000. So any individual depositor in a single account is insured up to $250,000 in case that bank were to fail. Additionally, remember the Fed has many functions. One function of the Fed is regulation, and regulation is theoretically supposed to prevent bank panics. The anecdote of the Goldsmith provides an excellent background to explain how the modern banking system works and how banks introduce new monies into the economy when loans are granted. To explain this process, it's important to understand the balance sheet of a commercial bank. Hopefully most students are familiar with the fundamental accounting equation. This is the balance sheet equation. Assets equal liabilities plus net worth. A balance sheet is a snapshot in time of a firm's financial standing. Here we have created the balance sheet of a fictitious bank, ABC Bank balance sheet. This bank has been in business for exactly 1 month, and they've taken in from their customers 100,000 in checkable deposits. So when you look on the right, the liabilities, these $100,000 in checkable deposits are bank customers' monies. That's why it's a liability for the bank. But now the bank has 100,000 in cash. What can a bank do with the assets it now possesses? Well, banks are in business to make money. The banks are going to take that 100,000 in cash, and they're going to perform one of two tasks. Either they're going to create loans, or they're going to buy financial instruments. Now, banks are restricted on what type of financial instruments they're allowed to purchase based on risk factors. Let's assume that by the 15th of February, same year, this now represents the bank's balance sheet. The bank still has the same checkable deposits, 100,000. But look what it's done with its assets. First, the bank created $25,000 in loans. Then the bank bought $25,000 worth of mortgage-backed securities. Typically, banks are permitted to purchase mortgage-backed securities which have been issued by the Fannie Mae and Freddie Mac, so to some degree are related to government-sponsored mortgage programs. ABC Bank also bought $25,000 worth of treasuries, that is to say, government bonds. Now, this doesn't specify. For simplicity, we'll just assume that this bank bought $25,000 worth of 10-year treasury bonds that were issued in February of 2023. This bank is in a position to create another $25,000 worth of loans and therefore introduce $25,000 worth of new money into the economy. The banking system provides the lifeblood of the American economy. Think of loans as the fluid which greases the wheels of economic activity. Households turn to banks to borrow money to finance automobiles and homes. Businesses depend on the lending facility of commercial banks to facilitate investment in new projects, and this is how the economy grows. Private businesses purchase equipment, machines, look for new growth opportunities in new strategic business units. Without the lending facility provided by banks, none of these economic opportunities would be available. So loans are an extremely important part of the macroeconomic success of capitalism. In the previous slide, we discussed ABC's balance sheet in February. They had 100,000 in checkable deposits, and we looked at the various assets that offset that liability. Look what's happened here. Checkable deposits have fallen by 50,000. Now, why has that happened? That is because bank customers took money out of the bank. Look on the left side of the balance sheet, the assets side. Notice already that liabilities dropped from 100,000 to 50,000 because customers withdrew their funds. How did it affect the assets that the bank was holding? Well, look what happened to the cash balance. This bank no longer has any cash balance. That $25,000 in cash balance, that's gone. We call that cash balance reserve balance. When a bank is holding reserves, it's in a position to lend out money and therefore introduce new money into the economy in the form of loans. Just discussed how important loans are to the economic well-being of the country. So when banks hold reserves, they're in a position to create new monies, introduce new economic activity into the economy. When reserves are not available to be lent out to households and businesses, that economic opportunity dries up. So 25,000 in cash wiped off the ABC balance sheet when depositors withdrew their funds. Notice also that Treasury securities dropped from 25,000 to zero. A lot of talk recently about problems in the banking system. A few banks failed this year, the most prominent being SVB or Silicon Valley Bank. Why did Silicon Valley Bank fail? Well, when bank customers began to worry about the financial stability of the bank, they began to withdraw funds. SVB Bank had purchased large quantities of Treasury securities. One of the risks involved with interest rates is the idea of when interest rates change, sometimes we call that the reinvestment risk. So imagine if ABC Bank had purchased $25,000 in mortgage-backed securities, and those mortgage-backed securities had an interest rate of 1%. Sounds low, but that was the interest rate on Treasury securities from the pandemic up until the beginning of 2022. When interest rates rose in the economy, all of a sudden the market value of those Treasury securities declined. Remember the inverse relationship between interest rates and bond prices. That is why SVB Bank came under financial pressure. Most importantly for introductory macroeconomic student learning, when checkable deposits are withdrawn from banks, there is a credit contraction. Again, this bank now holds no reserve balances and therefore is not in a position to create any more loans and therefore not in a position to facilitate the expansion of economic activity in the U.S. economy. Let's finish up this video by reaffirming two important points. First, a fractional reserve banking system is what makes lending and money creation available in the banking system and in the U.S. economy. If banks were required to hold all checkable deposits and were not permitted to lend out some fraction of the reserves, banks would not be in a position to create loans and therefore not be in a position to create new monies. So when a loan is granted or created, new money is introduced in the economy. When a loan is repaid, money is destroyed or taken out of the economy, and it's the fractional reserve banking system which makes this possible. For a significant amount of time in modern economic banking history, all banks were mandated by the Fed to hold what was called a required reserve. 10% of checkable deposits needed to be deposited in the bank's vault or on reserve with the Fed. Banks were permitted to lend out the remaining reserves, they were referred to as excess reserves. However, in March 2020, in response to the pandemic and the serious economic contraction that was caused by the voluntary shutdown of the economy, the Fed eliminated the required reserves. The required reserve ratio no longer a part of the banking system. It may be reintroduced at some point in the future. The Federal Reserve changed policies from what was called limited reserves to what they now refer to as ample reserves. But still an important point for introductory students to understand. Banks holding reserves are in a position to make new loans, to create new money into the U.S. economy. Banks also understand that depositors can withdraw reserves at any moment or a moment's time based on the desire to take their funds and place them elsewhere. One interesting real-life observation about bank reserves and changes in technology affecting the banking system. Years ago, people had to go to the bank physically, fill out a withdrawal form, and take money out of the bank. Therefore, the process was a little more time-consuming and to some degree a bit more predictable. The fact that bank customers can now move funds with the click of a phone or a computer, banks were caught off guard, especially Silicon Valley Bank, about how quickly reserves were drained from their balance sheet. Already demonstrated on the previous slide how this creates a credit contraction and the economic consequences of a credit contraction. In the next video, in-depth analysis of monetary policy and to some degree revisiting the principles of money, banking, and loans.